Believe it or not, I'm going to try to make a quick video explaining how to keep track of your stock options profits. That's right. I'm just calling it profits right now, because using the Straddler stock option strategy that I've been talking about, specifically over the last week, because I've been providing actual purchases and making them along with the video, because I'm so happy with what the option straddler is providing. I mean, it's doing what we want to do now. And it's been going very well. So I wanted to make this video about, not about looking at Monday here, the 24th, but I wanted to show you exactly how much profit you're making, how you can keep track of it, because you're buying paired options. Meaning when I discuss which company you pick here, like, are you going to buy Gilead right now? There's a possibility, actually. I might buy Gilead. I'll look up their price before the end of the video. But assuming we did, it would cost us a couple $100 or maybe more, because we might want to get the option period for when they have earnings, which is next week, the 3rd. So we'd want the different option period that expires, I guess, what, 8/11 maybe? And that's going to be a different price. But we're not going to make this video about that. We're going to make this video about what we've already made, because I wanted to talk about how I make decisions, use this to make decisions on when to sell and how to keep track of your profit. For example, the summary is of things that I talked about buying and made purchases, oftentimes during the video that I was recording. I would actually make these purchases. I talked about Johnson & Johnson, Abbott Labs. Schwab was number one the day before this video, I believe. And then I talked about Merck the day after I bought one of them, but then I said I was going to buy another one, and I did buy that one. So everything I've been laying out is purchased here, and I was able to keep track of it and pull it out of the transaction history to explain what's going on. So there's the active portfolio you have, which is all this stuff. This is all only stuff I talked about in the video, and I will keep this for all video discussions. So, like, if we're not going to make a purchase today, but if we were, I would add it to this list, and I'll do that tomorrow, after going over tomorrow, if there are any purchases. But what I wanted to show was, all right, overall right now, if you combine and you look at what that total portfolio impact is of all the trades that the algorithm was picking out really good companies, so much so that I had to buy them, and did that. Well, that's saying that it cost you $2,352 to buy what I said since the beginning of last week, which is about like the 19th. It looks like the 18th. First purchase we had was on the 18th. So we're going early into last week, about a week, right? A little more than that. So there was a cost of $23.52. You were able to sell this stuff for $26.51, except you haven't sold this stuff yet. This is all active. So that's why this number is including active account value plus actual sales. What you actually did was you actually bought $856 worth of stuff, sold it for $1,500, and made $678 on these loan options right here, making 79% profit. Now that's deceiving, though. That is not your total profit, because these are paired transactions. As you can see, our total profit here is only $299 so far, which includes current account value, which is actually down overall. $379 is what the total of everything we own is worth, less than what we bought it for right now. However, let me explain to you some interesting, as you dig into this information, you'll start to see that the cost of some things is actually zero, and we're going to move them down here. So let's see if we can back up, and we will make this quick. It says we're up about $300 or 12.72% right now on the stuff I told everyone to buy and that I bought in the videos. That is acceptable to me. If I'm making 10% a week, I'm really happy with how this strategy works. That's awesome. All right, so I'm going to say that's a success right now. But I want to look at it in the way that my brain has adjusted to understand these paired options and pull them out of here. Let me explain why. So what you've got is I colored the options. The yellow ones are the ones that are active, where I have both of them, both of the pair, both the call and the put. So these ones you haven't sold any of them yet. So the threshold about how much you're going to sell any one of those for matters when it comes to the total cost of both of them, because you want to profit on the paired transaction. So with the straddle where you're buying the call and the put, the ones in pink are ones where I've already sold the other side of this option and I already made a profit on it. And I made sure that profit was enough to cover the cost of the other side of the pair. So let's move the price around, for example. Let's start with Merck. I think I still own, it might actually have sold during this video, but I own a Merck that expires this Friday at $108 put is what I have on them. That was worth about 74 bucks. I put an order to sell this thing for 79, and I don't know if it's gone yet. Why did I do that? Why would I sell it for $79 when it cost $102.66 for me to buy that contract? Why on earth would I be willing to sell it 4 days before it expires for less money and take a loss? The answer is I'm not taking a loss. Even though you're taking a loss on this one option, I'm not taking a loss on the pair. The other one I bought for 169 and I sold already for 280, which ended up being 279.34 after the fee. So let's take this 102.66 and let's add it to the cost of the option that we've already sold at the bottom. Then you start to see what I think of in my head. This cost is now going to go away from our active portfolio. We're going to assume that our cost is 0 here now. Why? Because I added it to its pair that we've already sold. And that shows you a much more reasonable gain loss number and much more reasonable gain percentage. Okay. Now you're like, all right, well, wait a minute. On this sale that I had where I bought an option on the 20th and sold it the next day on the 21st, it's true. I only made 3%, 2.5% overall on my transaction right here. That's not that much. That's not 10%, right? That's less. But don't forget, you actually still own the other one that you haven't sold yet. And so if it goes for 79, which is what I'm trying to get it to go for, it's going to be plus 79 minus 66 cents for the fee. Then all of a sudden, you're going to end up with a 31% profit overall, and you're going to make 85 bucks. And even if I sold it for $74, which is its market rate right now, and that would go right now, I still make almost 30%. As you can see, I put a little higher number up here because I wanted to make more than 30% on this first Merc. I thought that was, a great thing. If we end up selling this other one on 7/24, being today, it's 4 days you've owned it, and you make almost 30%. Okay. So now let's get that out of there. So this is the way that I think about the paired transactions. So let's add the cost of the other ones that we've already gotten out of these as winners. For example, Sherwin-Williams. Oh, sorry, not Sherwin-Williams. Schwab. Sherwin-Williams was a good company back before they just kept going up, 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 and up. They're still pretty good. But Schwab is the company we're talking about. Well, we have purchased this other Schwab here for 101.66. So let's add that here. See if no, I need to put the equal sign even in Google Sheets. Sometimes it's smart enough to fix it for you. So here you can see that the Schwab still managed to pull down a 26% profit on that first sale, which was fantastic because the Schwab went for 372 on the night. 1 day later, right? They moved after earnings, and the next day they moved again, and that is why this was obvious in the algorithm. And look at that, 26% in 1 day, and you've still got this one that's worth 23 bucks right now. So if you want to sell it right now, right? You could add that 23, make the sale, and all of a sudden your profit on Schwab is 34%, 101 bucks in what ends up being this number of total days because you make the sale today, right? So it's 6 days and you make 34%. So if you're starting to see just how incredible this is, because you've already made money. Like if we back up and we remove all the Schwab stuff, it really needs to be gone from here, but you've already made 78 bucks on this. And you're sitting and free rolling with this other side. It's kind of like, see how you really have trouble losing money when you freeze in your profit early. Let's look at Johnson & Johnson, because that sold today. What happened? They went up again, like I thought they would. Actually, it's when I actually predicted the correct direction. I was able to sell it for 575 bucks today, netting $147 in 4 days, 34% already, and we still own a put on them that expires Friday. Could be another 18 bucks if we sold it right now, but that's so low. I'll just hold on to it, and we'll see if J&J accidentally goes down for some reason, because that'll be worth more. But look at this, 34%. What about Abbott Labs? Abbott Labs, we end up selling for a little over $300. This percentage is not going to be that huge, I don't think. Let's find out. Plus 94.66. Yeah, I mean, still almost 10%, but not quite. Yeah, we still have one that's worth 11 bucks. That would get us there over our 10% if I sold the Abbott Labs right now. And I might do that just to try to hit the goal of making 10% per week, because that's about how long this is. It's almost 5 market days. So if we want to try to guarantee 10%, then this is kind of telling you maybe you should unload that Abbott Labs for 11 bucks. I know it's not much money, but it gets you there. You know, it gets you up to a $36, $37 profit. Maybe you try to sell it for a little more, try to catch them on a down day or something, wait another day and then try it. But the point is this is now all of a sudden kind of how things look. Let's change this gain number to be market value minus cost. Because I pulled this right off, so it doesn't, these weren't formulas yet. I'm just changing them now. So what that shows you is that the market value of what we still have, where we've removed the actual cost from the other paired transaction that it's related to, and added it to the correct one, that this is more what it looks like, which is, yeah, that like on all your sales, yeah, you've made 258 bucks. You've made 20% so far, assuming you make that sale on, I guess it's Schwab is the one I left in here, right? Well, whatever. The point is, it's pretty close, but I wanted you to see exactly what it really looks like, because what I'm watching for today is I'm saying, you know, am I going to unload this Merc right now at 79 bucks? Like I'll see if it goes. I think it's a great idea to do so, because I mean, look at what it does to my gain percentage. I'm at only 3% gain on my Merc right now, but if you add the 79 bucks, 78 bucks or whatever, all of a sudden I get to 30%. So even though it's early in the week, you're hitting a 30% threshold. It's pretty nice. And I own another Merc anyway, because I thought it was such a great purchase. So I own another one at a different strike price, meaning I can afford to take this 30% right now and not have a fear of losing out on if they go down further, because I have $110 put on him on Merc right here, which is already up money, and they may continue to go down, but we may as well freeze this profit right now. It's the advantage of owning multiple ones on the same company. So I kind of want to advise going forward, you should get your budget straight to the point where you can buy a few of these, and you can do more fun things like this, where you do this right, you can be free rolling completely with 2 of them over an option period, because you'll sell each one of them at a different fluctuation and potentially profit enough that you could have a couple free rolling on both sides. That's almost a goal if you want to play this in terms of like a game, being like, can you find the best companies that move the most at the best price? Like, is Gilead one of them today? Kind of. I mean, I'm gonna look at their actual I'm gonna look at the price, not for this one this week, because this is now too close. We're now only, it's now Monday. It's too late to buy options that expire this week. You need to have more time on them. So we're going to look at what their option is for what I believe is the 8/11 period. And I'm digging for that right now. We're going to add that in here and we're going to make a decision because they're high up here on the boom list, but I know that their option is going to get more expensive. So they're discontinuing a study on something, and so they've gone down, but they also have earnings 10 days from now. So the option period that includes their earnings next week, because it's at August 4th. They report earnings on the 3rd, so it's not the 11th, it's the 4th. All right. So what we're going to find out is what the new price is and whether or not it's worth it. It's going to be expensive. Let's see. Their new strike price, where they are right now, is at 77. The low is 209 to 214. And the put is 157 and 163. It's actually not as expensive as I thought. So it's $371. They moved over through, look at that. They're still moving down. The arc for them is probably going to be down. Earnings are probably going to be bad. And this is a start to that. And it's probably going to keep going down. So I'm tempted to only buy the put, but don't listen to me. Listen to the strategy. Listen to the algorithm. You can see that their boom number moves to 88%. So now they're only down here in number 6. But it's a longer option and it includes their earnings. So I actually am going to give the thumbs up and I think I'm going to buy one because even though they're only $77 a share, they got earnings coming up. And the break-even boom is less than 5%, but you're including earnings and you're giving yourself 9 days. So you can see that it almost hit it today and they're still 9 days away from earnings. So this is actually viable. Anytime you can get a company that's going through earnings that has some fluctuation potential for under 400 bucks, like are they going to move $4 a share in either direction? They already moved 330 today and they're 10 days away from earnings. So the algorithm is accurately picking this up. Occidental is not too much cheaper. It's cheaper to pay for, but not too much cheaper in share price. Yeah, you got a very good chance of making money here. So I'm going to buy that right now and we're going to add it to the list. And I'm going to buy the put first though. And that's because I think that that's the direction they're going to go. And then I'm going to come in with a lower ball offer for my call option. So I'm going to buy this at 78 because I believe they are going down. Okay. So we're going to record exactly what I purchased right here. I want to take a higher number because I want the put is what I want to buy first. And the put is going to cost me, I'm coming in for 200 and it's right about $204. I'm coming in at I'll come in at 203 and see if that goes. So I'm trying to come in for 203 bucks. It's right between, stay with me here because this is the thought process. Like I did enough research that the algorithm knows what it's doing. So when it picks off companies that have a lot of good factors like earnings coming up in the period, less than 400 bucks, they have a flux that, people like to trade them. I don't have a lot of faith in the company, which is why I'm trying to buy. Oh, I got it. It went through. I got it at 203. So that worked out. Now I got to buy the call. And I don't want to pay as much for the call because I don't think they're going up. I think they're going down. But you have to buy it. It's what the strategy says you have to do because you don't know, Ken. You don't know which way they're going to go. As much as you'd like to, it's short term. You don't know. It might come out with great earnings, for example. Who knows? Like you don't know. So that's the $78 call is between 164 and 173 right now. So I'm going to come in on the low end because I think that they are still going to go down. I'm going to come in a lot lower. All right. I'm going to come in for 1, 2, 3. I'm going to go, let's see, 204 plus how much do we want to pay for this? I'm going to come in at 149. Yeah, I know that's way too low. We're gonna see if that goes though, before the end of the video or the end of the day. 149.65. So I'm in like 20 bucks lower than what it's going for right now, because I assume that Gilead's going to keep going down for the next couple hours today, and that option may actually sell. If it doesn't go and I can't buy it by the end of the day, I'm going to take whatever the market rate is for Gilead, unless all of a sudden they flipped completely and started going up ridiculously fast, which I don't think is going to happen. If they did that, then I would have to pay a lot more for that call, and I would probably like wait till tomorrow or something, or potentially get caught on the hook and only owning one of them. I don't recommend that, but I feel so strongly about this company personally because I've seen them in the past, and I just don't trust them to go up. Certainly in the short term, after that kind of bad news about discontinuing something they were working on, because that's basically saying that a lot of the R&D costs related to whatever that treatment or what product or whatever was going to be is going to be sunk cost now and not going to be doing anything with it most likely. So that is negative financial news for the company. So we'll see if I can get that call super cheap. So what did we buy, right? This is what we bought. Bought some stuff today. To show you what it looks like. It's going to be an active thing. It's going to be GLD August 4. It's a 77 put. I don't know if it's a weekly or not. Doesn't matter. The weekly thing is just some of the options are sold weekly on a weekly basis, and some of them are sold on like months and quarters and stuff like that. So they don't have the weekly designation. All right. So what we bought, this has got to be like 9 days till expiration. One of each. The cost of the put was 203.67, right? Or 66, I think, whatever. It's going to have a market value. I could tell you what it is, but we don't care all that much. How much could it have moved in the last minute, right? Let's go look, actually. It is worth 197, so I'm down right now. Bummer. We're down $6, but that's okay. So we'll see if I can buy this one for 149.66. Don't know. If it doesn't go, I'm gonna have to pay like 180 or something like that. So my cost could be upwards of 380, but we'll hopefully get it for less, right? Hopefully get it for 352-ish, which would be a fantastic deal. It's possible. We'll see. So that's how you do this, is you create these and you have a longer set of days now because they're till August 4th. And it's just the algorithm is pointing out something where, they come to the top. See, like Oxy, for example, Oxys are going to be a different price for next week. They're not a high share price enough company for me. And I almost want to delete them because oil industry stuff is tough to predict. And it's not huge mover. So I'm almost going to say no, leave them up there though. I left them up there because they have actually turned in nice percentage gains sometimes. So I don't want to completely rule stuff out, but you would want to update this price to the new option period to find out what it really costs, because it's not going to be that cheap. Is there anything else that's sticking out at us? Banks, JP Morgan just reported earnings recently though, so it's not the best time to buy them, but they are relatively cheap, but that's for the 728. You got to start adding new option periods in here. So I don't want to talk too much about what to buy, other than mentioning that Discover, which was number 1 on the list last week at one point, that they did actually reach where they need to reach, because they closed at about 102 the day after they reported earnings. And you can see these options were under $500 back then. And they moved more than $5. Like they're up now $6. So you do make money with that one. Again, one that the algorithm had is that I passed on because I thought this was too expensive, but they still get there. It just shows you that when you sort this by the boom number, this is a great list. You have to look at a few other factors to make sure everything is confirming to them, appropriately being where they are on the list. But once you do that, like what do you do with Ryanair? They just reported earnings. That's why they did this. And they're expensive. So I would say it needs to be reviewed, and they probably no, because they're not that big of a share company. JP Morgan, that's not bad. They're $158 share couple. Oh yeah, because it's this Friday. We need to update. Sorry, we need to update. So we're about done with that, but just wanted to let everybody know that the advice that I am giving through the algorithm is doing stuff like this. And I mean, it hits so frequently that, we'll eventually lose on one of these, right? Like maybe I'll lose on American Express because I bought it after earnings and it's kind of expensive. That might happen. When we take a loss, you'll see how that impacts everything. But as long as it's not a massive loss, you're making too much along the way. Like how much of that American Express could I lose? There's 154 plus 285. So it's $440 at risk. Right now, I could sell those for only 369. So I'm down about 80 bucks on them right now. Well, as the week goes on, I'm going to make a decision about trying to sell these for obviously trying to sell one of them for more than 440 bucks. Like I would accept 450 right now. Like if one of these options moved tomorrow and made it to $450, I would sell it. Like if they go down again and I'll sell it for 450 and I'll net my 10 bucks and then I'll hold the other one and try to get more profit that way. So it's about securing profit early so that you can do things like sell this Merc for 70, 80, 100 bucks or something a few days later when it was only worth $15 on the day you sold the other side of it. And it's a fun way of watching it because you can't lose. Like you've already made money. So you're just waiting to see what you can make here. And even though you can lose money from the market value point that you are at, like Merck might continue to go up, let's say, and the $74 will drop and I'll lose my chance to sell this, but the cost associated with zero because I already made the money down here. Didn't sell it yet, but I already made $7 on the whole transaction. I know it's not a lot, but boy, is it better than losing, right? Like when you're talking about growing your portfolio balance, these are the kind of decisions that are not hard and they are more fun when it comes to investing. It's like, oh, that's right. I already made money on this. Yeah, I might lose some of the 74, but I already made money on the paired transaction. Like I'm not losing money. Like you're seeing positive EV on every paired trade. You'll see we'll miss one of them eventually, but we've been since I refined the model, man, we've been hitting a lot. We have not missed since I added earnings. Have not missed. So, all right, we'll just see how it goes. All right, good luck, everybody. May all your trades be winning. May the algorithm be strong.